Your grandfather insured his farm for $12 an acre, signed the policy himself, understood every line of it, knew exactly what was covered and what wasn't. You pay $140 an acre. Same land, same weather, same drought that comes every 7 years, whether you're insured or not. 11 times the price. For the same promise that if the rain doesn't come, or comes too hard, or comes at the wrong time, someone will help cover what you lost. Your grandfather paid $12 and slept reasonably well. You pay $140 and read the exclusions at 2 in the morning, wondering what exactly is actually covered. Oh, in 1965, crop insurance was simple. A farmer paid a modest premium. A local agent who knew his farm wrote the policy. A local adjuster who understood his soil and his yields and evaluated any claim. The system was imperfect, but it was understandable, and it was affordable. Today, crop insurance is a federal program administered through private companies, subsidized by taxpayers, priced by actuarial models built on historical data that may or may not reflect what is actually happening in your specific field, in your specific county, in this specific decade of changing weather. The system grew larger, more complex, more expensive. And somewhere in that growth, the farmer went from being the person the system protected to being the person the system was built around, which is not quite the same thing. If old iron runs in your blood, subscribe to Classic Farm Iron. Most fellow farmers are watching right now. 3 forces drove farm insurance from $12 an acre to $140. Federalization of the program, consolidation of the industry, the increasing volatility that made the old math stop working. Each force made the system larger. Each force made the premium higher. And each force moved the farmer further from the person who wrote his policy and further from the decision about what his farm was actually worth protecting. Federalization first. Your grandfather bought insurance from a private company in a competitive market. Multiple insurers wanted his premium dollars. Mount competition kept the price close to what the risk actually cost. If one company's rates were unreasonable, another company offered better terms. The market worked in the farmer's favor because the farmer had options. The federal government entered crop insurance in 1938 with the Federal Crop Insurance Act. The program struggled for decades. Participation was low. Payouts were inconsistent. By the 1970s, federal crop insurance covered less than 3% of American farmland. Then came the farm crisis of the 1980s. Commodity prices collapsed. Land values fell 60%. Thousands of farms failed. Its Congress responded with the Federal Crop Insurance Act of 1980, then expanded the program dramatically with the Agricultural Risk Protection Act of 2000. Premium subsidies increased. Coverage types multiplied. Participation requirements tied to other federal programs pushed enrollment higher. By 2024, whilst federal crop insurance covers more than 90% of insured American farmland, the government subsidizes approximately 60% of every premium dollar paid. The program costs taxpayers roughly $10 billion per year. Plus, the farmer pays 40% of a premium that is itself priced by a federally regulated system administered through private companies that profit from the complexity they help create. Your grandfather's insurance company answered to its shareholders and to the competitive market. Your insurance program answers to Congress, the USDA Risk Management Agency, is 17 approved insurance providers, and a Federal Crop Insurance Corporation Board of Directors, none of whom have ever farmed your county. The system is not dishonest. It is not designed to harm farmers. But it is designed by people who understand risk management better than they understand what it costs to plant corn in a county where the rain stopped in July. Consolidation second. Your grandfather's local insurance agent knew his farm, had driven past it, had probably walked parts of it, knew which fields flooded first and which ones held up in a dry year. That knowledge informed the policy. The policy reflected the reality of that specific farm in that specific county. 17 companies are currently approved to sell federal crop insurance. The top 5 control more than 70% of all crop insurance premiums. Your local agent likely represents one of these 5 companies. He may have never walked your fields. He is entering your data into a system that prices your risk based on county-level averages, historical yield data, and actuarial models built by people in an office 3 states away. The adjuster who comes when you have a claim may cover 17 counties. He is measuring your loss against average yields from neighbors whose soil and practices may be completely different from yours. His assessment is systematic. It is designed to be consistent. So consistency and accuracy are not always the same thing. The consolidation of crop insurance followed the same pattern as elevator consolidation and fertilizer consolidation and seed consolidation. Local knowledge replaced by systematic process. Personal relationship replaced by data entry. Individual assessment replaced by county average. Also, the farmer as individual replaced by the farmer as data point in a risk pool. Your grandfather was a person to his insurance agent. You are a policy number to a risk management system that processes hundreds of thousands of similar policy numbers across 100 million acres. Volatility. Third, your grandfather farmed in a climate that was more predictable than yours. Yeah, not perfectly predictable. Drought came, floods came, hail came, but the patterns were more stable. The actuarial models built on historical data had a better chance of predicting what would actually happen in any given season. Today's weather patterns are less predictable than the models that price your insurance were built to handle. But extreme weather events are more frequent, more severe, more clustered in ways that strain insurance pools designed for individual farm losses, not regional catastrophes. When drought hits one county, the insurance pool absorbs the loss from premiums paid across hundreds of counties that had normal years. When drought hits an entire region simultaneously, the pool pays out across hundreds of counties at once. The math that worked when losses were scattered struggles when losses concentrate. The response to increasing volatility is higher premiums, not because insurance companies are profiting excessively, though the approved providers do earn consistent returns, but because the risk is genuinely higher than the historical models predicted it would be. And the farmer pays for that increased risk in his annual premium. The financial math is worth understanding directly. Your grandfather insured 500 acres at $12 per acre, $6,000 per year. In a decade of normal farming, but he might file one significant claim. The insurance hedge was a manageable line item in a farming operation that otherwise worked economically. You insure 500 acres at $140 per acre, $70,000 per year, before the government subsidy covers the other 60%. The full premium on 500 acres of corn runs approximately $175,000. You pay $70,000. The taxpayer pays the other $105,000 every year, whether you file a claim or not. Your grandfather's insurance was an expense. Your insurance is a federal subsidy program that happens to include some coverage for your specific farm. The subsidy structure creates its own complications. Because the government pays 60% of the premium, the effective cost to the farmer is lower than the actuarial price of risk. This encourages coverage on marginal land that might not be farmed if the farmer bore the full cost of insuring it. This is not the farmer's fault. If the government offers to pay 60% of your insurance premium, the rational economic choice is to take the subsidy. Every farmer does. Every farmer should. But the system created by that rational individual choice is a federal program costing $10 billion a year that encourages farming on land that might otherwise return to grass, that prices risk in ways that favor large operations over small ones, and that concentrates premium revenue in 17 approved companies whose profits are protected by the federal structure that certifies them. Some farmers found ways to reduce exposure, diversification, multiple crops reducing the chance that one failure takes the entire operation. Your grandfather diversified partly for this reason, not because he planned a formal risk management strategy, because common sense said not to put everything in one field. Livestock integration. About animals that produce income when crops fail. A buffer against the single crop vulnerability that makes insurance so expensive. On-farm water management. Irrigation infrastructure that reduces drought risk and therefore reduces the effective cost of the insurance you still need to carry. Soil health investment. Ground that holds water better in dry years and drains better in wet ones. The farmer who builds soil is buying insurance in the most direct way possible, reducing the risk itself rather than just paying to cover it. Your grandfather signed his insurance policy at a kitchen table across from a man who knew his land. $12 an acre, a handshake. A reasonable expectation that if the worst happened, someone would be there. With that, you sign your policy online or in an office with an agent who is entering your data into a system designed in Washington. $140 an acre, a signature on a document 40 pages long. A reasonable expectation that if the worst happens, the claims process will be systematic, consistent, and based on county averages that may or may not reflect what actually happened in your specific field. $12, $140. Same land, same risk, same prayer every spring that the weather cooperates and the policy doesn't have to be tested. What did your grandfather pay for crop insurance? Did he carry it every year or only when he felt the risk was high? Did he ever have to file a claim? Do you remember when insurance stopped feeling like protection and started feeling like just another cost that farming required? Is there a year your family remembers as the year the insurance actually mattered? Or a year when the claim was denied on a technicality you still don't fully understand? Tell us below, because the farmers who remember $12 premiums and local agents who knew their soil understand something about $140 in a federal subsidy program that no actuarial model will ever fully capture. And share this with a farmer who opens the insurance renewal every year and wonders what exactly $12 an acre used to buy that $140 somehow still doesn't guarantee.